Have you ever seen a company sell off a huge part of its business and the profit number just looks, well, a bit weird? That's exactly what we're digging into today. We're talking about group disposals, and I'm going to show you why one single sale can lead to two totally different, but both completely correct, profit numbers. It's wild.
Okay, so picture this. A big company sells off one of its smaller companies, a subsidiary. The question seems simple, right? Did they make a profit on the deal? You'd think it's a straight yes or no, but nope. In the world of corporate accounting, the real answer is, well, it kind of depends on who's asking. So here's our game plan. We'll start with what I call the two stories. We'll look at the parent's view versus the group's view. Then we're going to have to unpack two really key ideas: goodwill and NCI. And finally, we'll see how it all gets presented in the final statement. Let's dive in.
Okay, first things first. The absolute most important thing to get your head around with a group disposal is this. You are literally telling two different financial stories about the exact same transaction. Think of it like a fork in the road. When that sale happens, one path leads to the parent company's own individual financial statements. The other path leads to the big picture, the consolidated group accounts. They're both talking about the same sale, but from two very, very different perspectives.
All right, let's start with story number one. And good news, this one is by far the easier of the two. We're talking about calculating the profit from the parent company's point of view.
For the parent company itself, the logic is super simple. You just take the cash you got from the sale, the proceeds, and subtract what that investment was worth on your own books. Usually that's just what you paid for it in the first place. That's it. Cash received minus cost.
To make this real, let's follow an example. Let's say we have a parent company we'll call Rock, and it owns a 70% stake in a smaller company called Dog. Rock paid $2,000 for that stake. Then, a few years later, Rock sells its entire holding for $3,000. So, you can see how that simple logic plays out. It's just the $3,000 they got from the sale minus the $2,000 they originally paid. From the parent's individual perspective, it's just straightforward math. And boom, that gives us a nice, clean profit of $1,000. From the perspective of Rock as a standalone company, that's the profit it made on its investment. End of story. Or is it? Okay, now we turn down that other path, the one for the consolidated group accounts. And this, my friends, is where the story gets much more interesting. And yeah, a bit more complex. Whoa, okay, I know that formula looks like a beast, but stick with me because there's a really good reason it's so detailed. You see, from the group's perspective, you aren't just selling an investment, you are removing an entire operational business from your corporate family. We can break this whole thing down into four manageable steps. We start with the sale proceeds, just like before, but then we have to subtract everything the group is actually giving up: the subsidiary's net assets, this thing called goodwill, and another thing called the non-controlling interest. Before we start plugging in any numbers for our Rock and Dog example, we've got to hit the brakes for a second. We need to get on the same page about those two key terms I just mentioned: goodwill and NCI. They're super important for this. So what on earth is goodwill? Well, imagine you're buying a super popular local coffee shop. You're not just paying for the coffee machines and the chairs, right? You're paying for its amazing reputation, its loyal customers, its brand. All that extra value you pay on top of the physical stuff, that is goodwill.
And non-controlling interest, or NCI, that's even simpler. It's just the piece of the subsidiary that the parent company doesn't own. Remember, Rock bought 70% of Dog. That other 30%, well, that's the NCI. It belongs to other shareholders. When the group sells the subsidiary, it has to account for that other owner's share.
So here's the crucial point. For the group, a disposal is like a surgical removal. You're not just taking out an investment on paper, you are deconsolidating. That means you have to remove every single trace of that subsidiary, its assets, its goodwill, and the NCI share from the group's financial statements. Now, we're not going to get bogged down in the nitty-gritty of how these numbers were calculated, but for our example, what's important is that at the time of the sale, the goodwill associated with Dog was valued at $900, and the NCI stood at $950. And here is where it all comes together. We take our $3,000 in sale proceeds, but now we subtract all the elements of the business we're removing. We take out the net assets, we take out that $900 of goodwill, and we take out the $950 for the NCI. Just watch what happens to the profit figure. And look at that. The profit for the group as a whole is just $650. Remember that $1,000 profit we saw earlier? Yeah, this is a very different story.
And this chart just nails the core concept, doesn't it? One sale resulted in two completely different but equally valid profit figures. The parent, Rock, made a $1,000 profit on its financial investment, but the economic entity, the group, made only a $650 profit on disposing of the actual underlying business.
So we have this group profit of $650. But how does a company actually report this to its investors without causing a ton of confusion?
Well, it gets its own special line item, usually called something like profit for the period from discontinued operations. And this is crucial because it allows investors to see the performance of the core ongoing business separately from a big one-off sale. It gives them a much clearer picture of the company's future potential.
All right, so let's do a quick recap. Key takeaways. Number 1, a disposal creates two different results, one for the parent, one for the group. 2, the parent's calculation is simple, just proceeds versus cost. 3, the group's calculation is way more complex. You have to remove everything. And finally, 4, the result gets shown separately as a discontinued operation.
Which brings us right back to our big question. Why should one transaction have two different profit figures? Because it perfectly captures the idea that a company can be two things at once, a single legal entity and also part of a larger economic family. And in accounting, just like in life, perspective is everything.